I'm going to hit record. All right, so now I'm going to jump ahead. So welcome to cash flow and the annual operating cycle again. I'm Liz Higgins once again, and today, we're going to talk about cash. What is cash flow? How do we measure it? Why is it important? Some of the challenges you may face in maintaining cash flow in a farm business, and then some strategies for keeping the cash flowing throughout your business cycle. So what is cash? I mean, I think we all have some sense of what we're talking about cash, but it's any asset that's in currency form or highly liquid. It's the assets that you have that you can use to just pay expenses. Money in your account, it's money in your checking account, money in your savings account. It could be money that you access through borrowing and then use to pay bills or expenses. But basically, it's highly liquid assets that can be used immediately to pay bills or expenses would be cash. You can see cash, in your financial statements. And I just, as a refresher, I wanted to back up really quick. For those of you who may be newer to farm business management, there are three primary financial statements that a business will generate to show how they're doing. And the first is the balance sheet, and that will show all of a business's assets, what they have that has value, which could include cash, but also infrastructure, inventory, the liabilities that you have, that's what you owe. And then the difference between the two is the business's equity or the value of that business. So anytime you run a balance sheet, you're getting a snapshot of the value of that business at that moment in time. And that's where, you can, if you run a balance statement, you can see how much cash, assuming that it's done correctly, how much cash that business has. And it'll be up there under current assets, cash, it's very cleverly named. But not all current assets are cash. Accounts receivable, money that people owe you is a current asset, but it's not cash, because you can't say, well, I'm owed money and I'm going to pay you with that owed money. You actually have to have the cash, right? And then other assets are not cash either. So you can have a lot of wealth and not have a lot of cash. I guess the other thing I was going to say, the second financial statement is an income statement, and that will show the revenue coming in and the expenses going out. And that tends to be what captures profitability in that period of the business. And usually income statements are run quarterly or annually. And then the last financial statement is the cash flow statement. And that's really what we're going to focus on today. And the cash flow statement shows how much cash is coming in and going out of the business during each period. And it measures the ability of that business to pay its bills, essentially. And if you're borrowing money, it's something that a lender is going to look at, because then it'll help them assess whether or not you're going to be likely to be able to afford to pay back a loan payment, whether you'll have the cash available to make those payments, without having to sell, maybe that asset that you're financing. So it's that sort of that third part of the three key financial statements is your cash flow. And why is cash important? The amount of cash a farm holds, it's really important because you need cash to function. Having cash can help you pay for unexpected expenses. It can help you pay bills when your revenues aren't where you expect them to be. It's not to say your sole purpose as a farm should be to acquire cash. Because in the long run, you have to be able to make strategic investments in order to grow your farm. Cash savings accounts, they don't pay a lot of interest. So like if you've got a big pile of cash and you're just sitting on cash over time, given inflation, you could lose money sitting on that compared to other investments. But on the other hand, if you need cash, if you've got, bills that are due, people that you owe money, acquiring that cash can be really expensive also. I mean, you could end up paying really high interest rates on it. You might not be able to get it. And then people will start cutting you off, who supply you. So you absolutely it's the lifeblood of your business is cash. So what is cash flow? Then cash flow is pretty simple. It's that movement of cash in and out of your business over the course of a year, or over a course of a period. So in this graphic, this, highly technical graphic I constructed, you can see that there are periods in green where more cash is coming into the farm than going out. And then there's going to be other periods in red where there's more cash going out than is coming in. And so these are times where a farm might need to have a plan in order, to have some cash on hand when more money is going out than coming in order to make sure that they can cover expenses that they have. So cash flow is that sort of cyclical pattern of money coming in, money going out, and sometimes, it not necessarily being all even Steven. Cash into the business can come from a lot of different sources. It's more than just income. Cash coming into a business can be the money that you get when you borrow money. So like if I go and I get a loan, that loan, it's a liability on my balance sheet, but it's also it's money that I put in my checking account or my savings account. Cash can be from an equity investment into the business. It could be like off-farm money that you've got a different job, you get some money and you put it into your farm to help pay some bills. That could be an equity investment into it. It could come from a grant. There are lots of different places cash can come from. Ideally, if you're running a business, it's coming from income, but it's not only just income. Cash flow out can be your business expenses, but it can also be the purchase of an asset is cash out the door. And that's also, we'll talk about, I have a graphic differently, but so when you buy a piece of land, that down payment on that land, that chunk of money, that's cash going out. It can be principal payments on debt. It can be tax payments. It can be equity withdrawals. That money you take out of the business, maybe to live on, is all cash coming out of the business. So how do we measure it? It's really not highly technical. You start for each period. You first have to define your periods. Generally, people look at monthly, but it could be quarterly. But you define a period and then you have a starting cash balance. So how much money do you have in cash? And you're only looking at cash. And then you look at all of the cash coming in, not just your income, but maybe, like a loan that you get, or, money you find on the street, or, a lottery ticket winning, like whatever cash is coming in. And then you subtract out all the cash that's coming out during that period, the expenses you have for the business, but it could be money you took out to go, to live on. It could be a parking ticket you had to pay, all the cash that's coming out of your business. And then that's your ending cash balance. So every business, it has in the period a starting cash balance and an ending cash balance. And that's how you measure cash flow over the course of that business period, that business cycle. Cash flow, I just want to stress this, it's different from profit, right? So let's look at profit is your income that you're generating from the business minus the expenses that you have for the business, minus depreciation. And this is really important. When you buy an asset like a tractor or land, you don't, for looking at your income statement, you don't expense those kinds of assets, right? Like you depreciate those. And so you're not taking like the full value of that, that cost in that given year when you're calculating the profitability for your business. So it'd be income minus expenses minus depreciation would be your profit. And that's to see like, is the business actually, like from its business purpose, making a profit? Now your cash flow, your ending cash balance is your beginning cash balance plus income. So the income is the same, but it's also your sales of like capital items, so if you sold a tractor and that cash comes in, that would be a positive. Loan receipts. So if you get a loan and that loan money that you get and you put in the bank would be cash coming in. Another source, other money that's put into the business would be cash coming in. And then you subtract out your business expenses. So that's the same, but now you're also subtracting out the full cost of the cash that comes out of your business for capital purchase. And it wouldn't necessarily be the full value of that purchase, but it would be the cash that you took out to make that purchase. So your down payment, for example, would be that capital purchase minus, loan principal payments, minus other withdrawals from the business. And those are usually, those count as equity withdrawals, but for a cash flow statement, they come out. So you can see that this doesn't measure profitability, because you could have in a given quarter, a positive cash balance at the end, but not because of income, but because you sold a whole bunch of your infrastructure, right? Like, so a business that's doing really poorly, but they're taking out a lot of loans, and so they get loan money and they're selling off a lot of their infrastructure, could actually have really positive cash flow in a quarter, but it wouldn't be great because it's, not necessarily from things that are really going to like make that business healthy and profitable. So it is different from profit. On the other hand, if you're not profitable, over time, there's only so long you can sell off your infrastructure and get loans out before, that is not going to cover you anymore. So in the long run, positive cash flow is, correlated with profitability in a business, but it's not in any given period. It's not the same. So why is assessing cash flow important? Cash flow is one of the primary reasons why small businesses fail. Cash flow is a real problem for new businesses and small businesses because they often have trouble accessing affordable credit, and they may not have access to equity investments or savings that would get them through a period where they don't have income coming in. So you can have a business that in the long term will be highly profitable, and the idea is really good. So there's like fundamentally the business's idea is sound, the long-term profitability is good, but whoever is running that business doesn't have the cash to keep going long enough to be viable, because they'll run out of money before they start seeing money come in. Vineyards are a really great example. When you plant a vineyard, year one, you're laying out, like $9,000, almost $10,000 an acre, and you're not seeing any cash coming in. Year two, you're laying out $800 an acre. You're not seeing any cash coming in. Year three, you're laying out another $1,600 an acre. You're not seeing any cash coming in. And so you've got no revenue for 3 years and a lot of outgoing money. In the long run, with a vineyard, you could see profits of $300 to $1,000 an acre, going forward. But you've got to be able to survive with, have enough cash to survive those first 3 years. So that's why, just as you've got a good idea, you have to have access to cash. So that is just like really, really, I think a really important thing to understand. And I think it's why a lot of farms, really, really struggle in the long run is not really getting that. Really assessing cash flow can help you plan to have enough cash on hand, so that you can pay, so that you have it on hand when you need to pay seasonal expenses and to weather unexpected expenses and emergencies. It's really important for a business, especially a new business or a new business venture, to think about cash flow and budget for it so that you can minimize your risk and really keep going as you're starting to build up the business. There is sort of a cash flow budgeting cycle. One of the pieces in determining what you need to do to manage cash flow is to first develop a cash flow budget. And this budget helps you plan for your season by anticipating when cash will come in and go out, so that you can really try to make sure you always have enough cash on hand to pay your bills. During the season, you will then run cash flow statements to see how you're performing against your budget. And then if you find that when you're doing the statements, you're under your budget, you're over your budget, you can make adjustments. And then that will, inform your next year's budget, right? You'll have a better budget. And my key point with this is that this is an ongoing process in your business. This is not just something that you assess once, a one and done, but it's constantly making sure that you've really got enough cash on hand, and you're anticipating like what that flow will be throughout the season. So there's 4 challenges to maintaining cash flow. You're going to find that there are times when you don't meet your targets. And one issue is seasonality of expenses. Many crop farms you will find in the spring, you've got a lot of money coming out. You don't have a lot of money coming in. And a cash flow budget is really important for businesses like that to help you manage seasonality so that you don't come up short. But other reasons why, you could run into cash flow issues could be you make a large investment like the vineyard and it doesn't show revenue for a while. You may need more cash on hand then to cover that expense. You can have unanticipated expenses. Everybody's had expenses like this year for COVID-19. A lot of farms are having to put in measures and have extra costs that they had not planned for. You could have unanticipated declines in revenue. This year, maybe some of you lost sales outlets in the past that had been really reliable, like restaurants. And these things happen in every single business, and they really need to be anticipated. So there are different strategies, and each of these issues requires a slightly different strategy for thinking about keeping cash flowing. Seasonality is just something that you need to plan for, right? If you have a business that's seasonal, and most farms on some level are going to be seasonal, this needs to be like thinking about cash flow needs to be part of your planning, so better budgeting, right? So, you don't, when you get a big chunk of money at the end of the year, you plan for what your cash needs are going to be for next year. You don't just spend it all, right, on equipment or whatever. You can request the adjustment and timing to your bills. You can divide big bills into multiple payments so that, when you've got less cash coming in, you don't have, you're trying to balance when your cash is coming in and your cash is going out. And a lot of creditors and lenders and others, who work, especially those who work with farm communities and seasonal farms, they understand this, and many of them will work with farms around that. Using loans can be really important because, then you guarantee that you have that cash available. If you can get a low interest operating loan, that could keep you from having to get a panic high interest loan or not being able to get a loan when you have a crisis, or something unexpected happens to tide you through. Lines of credit, establishing a line of credit if your business is otherwise really profitable and your interest is reasonable is a good thing, so that you have that access to credit, sort of ready to balance out sort of, costs during the year. And then, considering alternative sources of revenue for your business that can generate cash during those slow periods, maybe another strategy. Another issue we talked about is high upfront costs with a long payback period. One is, in this case, using credit really wisely. So a lot of times there are people that are very afraid of credit. They don't like to have debt, but, if you have a choice, let's say you've saved, $20,000, if you take 18 of that and you put it on a down payment for a piece of property, leaving yourself with $2,000, and then you might not have enough cash to get through the year, and depending on where your business is, you may not have enough money and access to money during the year to pay your bills. So one mistake I see a lot of farms make is that they fear credit so much they don't really see credit as part of their cash flow management strategy. So especially beginning farms where you're undercapitalized and you make a large purchase, and then you're too cash poor to operate. Renting or leasing, until you have cash coming in for the business could be a better strategy. Even if, you run the numbers and it seems like it would be more cost effective to own, you really have to factor like your ability to access cash into that equation. Because if you can't get, if tying up all your cash reserves, cash is going into now infrastructure, that could leave you, what seems like a really good deal may not be such a good deal when all of a sudden other bills come due. Consider putting off an investment until you have more cash might be something that you just have to do. Maybe you want to do a vineyard, you want to do a vineyard, but when you run the numbers, you need to have another income stream more developed until you can afford to do the vineyard. So something that generates more source of revenue while waiting. A lot of times, and I'll use like vineyards, for example, I get people who want to be winemakers and have a vineyard. my recommendation is often start with making the wine first, not the grapes, because you've got this long lag with grapes, so you've got nothing to sell. And frankly, even once you have something to sell, it's grapes, right? Like, whereas if you make wine first, you can get the wine faster because you can buy the grapes from somebody else. And the wine's, much more profitable. And then that profit that you generate, you can then turn around and start a vineyard because you'll have cash coming in. Alternative sources of revenue that generate cash while you're waiting, or selling underutilized assets and use the cash to tide you over until the new venture is profitable is another strategy. But now when we talk about unanticipated expenses or declines in revenue, your situation is different because these are not positive phases generally in a business cycle. Rather, these are risks that you're planning for. So assuming you don't have enough cash on hand, you really need to determine, is this a temporary, or a permanent change? Is this a big expense and it's going to be a new permanent expense, or a permanent decline in revenue? Or is this just some blip that you just sort of have to get through? Loans can make a lot of sense if you're just tiding the business over to get over the hump. But if this is a more sustained change, you might need to look at cutting expenses, selling off unproductive assets, and then in an emergency, having insurance, or assistance, things like the PPP program, other ways of bringing in cash. Because, if there's a fundamental change in your business like this, you can't necessarily like borrow your way out of it because you still haven't figured out how to get the cash eventually to come back in. So not all cash flow issues really would necessarily be dealt with the same way. And so, really using credit wisely, and credit is still really important in these situations, but how you borrow and what you borrow really needs to also be considering like what is going to happen to this business going forward too. And then how much cash should you have? You need enough cash to pay your obligations. Your best case scenario is that your business holds enough cash to get you through tough times and give yourself some breathing space to regroup and to be able to afford to like make investments, strategic investments, without it really harming your ability to also pay your recurring expenses. So this year, for example, some farms may have received CFAP funding or paycheck protection loans or grants. And I hear that, some farms are looking to reinvest some of those funds back into the business. And although that might really be the right thing to do, that should be done after you make sure that your farm's cash reserves are adequate. So here are some guidelines, and every farm is different. Farms may have different abilities to access credit or to generate credit revenue from other sources. So these are rules of thumb. These are not absolutes, but if you've got a really stable business, having a cash reserve equal to a couple of months, it might be enough, especially if you've really got good access to affordable credit, you're an established business, and you've got, multiple ways of accessing some money, and things are pretty stable. But if your business is more volatile, and if you have less of a track record, so getting loans, or affordable credit could be more challenging, you probably need to have more cash, especially when you're in that startup phase. So you might want to have 6 months or more, because you might not have enough revenue coming in. Things can go awry. You might not be able to get credit that's affordable. So, so a startup business or a business that, can't get affordable credit, or a more volatile business, really definitely, I think, needs to figure out a way to have more cash on hand just to make sure that they can sustain themselves and be viable. So with that, I guess, this is my contact information, and I'll turn it over at this point to questions.